Hello everyone, Tracy here. We have an amazing conversation coming up in this week's episode of the Impact Farming Show. But before we do, a quick note from this week's show sponsor. Where are you on the path to farm transition? Explore this and more in Season 3 of the FCC Talking Farm and Food podcast, presented by Ag Expert. Hosted by FCC business advisors and transition experts, each episode features a new topic and a different step in the process. Tune in or subscribe wherever you get your podcasts. Thank you to Farm Credit Canada. Now let's dive in. Hello, everybody, and welcome to another episode of the Impact Farming Show. Today we have the always amazing David Derwin joining us. David, how are you?
I'm doing great. Good to see you again, Tracy.
I am so happy to see you again and happy to have you on the show to be doing our segment here, grain marketing in our current environment. So many of you guys that watch the show all the time, you will have seen David on the show. He is commodity portfolio manager at PI Financial. And you know what, David, before we dive into the presentation that you have for us today, do you want to tell our audience a little bit more about who you are and the work you do with farmers?
Absolutely. I mean, essentially, what I work on is helping farm businesses fine tune, improve, and take their grain marketing to the next level using a lot of tools that allow them to do more, allow them to try and get more out of every bushel, so to speak, and use some tools that are giving them flexibility, giving them the ability to separate some of their delivery decisions from their pricing decisions, and giving them an advantage to what the markets are doing, giving them an advantage in terms of how they can market their grain, and especially in an environment like we're seeing today where prices are high, but sometimes not as high as they have been recently, and always with a lot of volatility. So more tools you have in the toolbox, the better it is to be able to deal with the market environment.
Okay, excellent. So I know you have a great presentation for us going through the commodities and a lot of the factors at play right now. Why don't we start off? I really have a key question, and I'm sure it's on many of our minds. And why don't we start off with inflation or deflation? Which one will be the key issue going forward?
Right. And that is important because those bigger picture price trends certainly drive all commodities, especially the grain and crop prices that are so important to us. And as you can see, the looking at calling this here the big picture. And I think it's important sometimes to step back to see where we've been, where we are, and more importantly, where we could be going. And that inflation deflation scenario has been getting a lot of attention lately. You rewind several years and it was all about deflation, prices going down, interest rates low, and central banks and governments really trying to encourage inflationary pressures. Well, sometimes you got to be careful what you wish for, because more recently it's changed to inflation, where we saw interest or inflation rates around the world at 6, 7, 8, 9, 10%. And that's a far stretch from where they were before at the 1 or 2%. And that has a direct impact on our grain prices. And, it's interesting when you take a really big picture, a longer term view of things. And the first chart here really caught my attention when I put it together and crunched a bunch of numbers on some very long-term grain prices. And when you look at the longer-term big picture of grain prices, this is just a chart of an index of 4 of the largest traded grain futures prices, including wheat, corn, soybeans, and oats. And when you go back, 50 years here, going back to the 70s, you see some similar patterns that develop. And over that time frame, there have been about a dozen or so quite dramatic price spikes that developed. And except for once here when we saw during the 2008, rise in commodity prices, the pattern unfortunately has always been the same. You have a big move up, and then over the next year or so, it tends to settle back down to where it began. And you can see that over and over and over. More recently here in the 2000s, we've had it occur a couple of times, and we're going through another one of those scenarios right now where grain prices, as we all know, moved up quite dramatically. And we're in a process now where that is starting to unwind. Whether it develops as the other patterns did, where they all drift back lower to where they started from, remains to be seen. But unfortunately, we're starting to see that trend in the other direction develop. And I hope I'm wrong, but that's that's what we're seeing. Objectively, you got to call a spade, and that's what we're looking at. And it's important also to step back and realize what caused this grain price increase. And it started many years ago, really. When you look back in 2020, we had the global pandemic that caused food hoarding and pricing to go up. Okay. And then we move on to 2021, where we had drought in a lot of the main growing regions, especially here in Canada. And then in 2022, we had a invasion in one of the major bread baskets around the world. So those are three very significant, somewhat unique events that in and of itself can cause some dramatic price moves. But when you combine them all together over a 3-year period, one after another, it really does have an impact on those prices. So now that we've gone through that and we're starting to unwind, a lot of people are still looking back at those prices with, canola at, you can call it 1,100-1,200 bucks a ton. Wheat futures getting up to $12-13 a bushel US. And it would take one or two events with a similar impact to cause prices to go up in a big way again. So, all those factors are still important, but they're starting to unwind. And even the situation in Russia, it often comes up, well, what if this happens? What if a nuclear bomb gets set off? And then, yeah, that would have a pretty big impact for sure. But as it is right now, grain is flowing through those areas. And, it's not that it's not dramatic and such a important event, but it's not necessarily a surprise or new news anymore. So as that works its way through the markets, money, especially more speculative hedge fund and investment fund money that's going into those typical inflation hedges, that starts to unwind, because as we can see, the prices peaked out, and now unfortunately they're going in the other direction. And again, I hope I'm wrong, but does that mean we get canola starting to go back to the 600 levels? Corn prices dropping down into the $4, $4.50, $5 levels. As we know in these markets, you can never say never. So as it stands now, it's not just grain prices that we're starting to see drift lower, and slowly seeing that inflationary issue turn into more of a, I don't want to say deflationary, but at least disinflationary level, where pricing isn't going up as much. But here is just a chart of Bloomberg Commodity Index, which comprises a lot of different commodities, from energy prices like oil and gas and diesel and copper and silver, and all the grain prices and cattle and other foodstuffs like sugar and cocoa. And that is following a similar pattern. This is a much shorter term chart. It only goes back about 5 years, but you can still see what's happened back in 2020, when prices really started to move up following the COVID situation. They kept drifting higher and higher and higher until it was really forced up and met its peak there just shortly after the situation in the Ukraine. So these prices have been slowly drifting lower. And as I like to say, financial gravity is really pulling down on these prices. So without any type of major event to turn that around, gravity is going to do what it does best. It just pulls down on things, right? So we're seeing that across a broad base of commodities. We saw it in grain markets starting already. And probably one of the more important ones is crude oil. it really is the king of all commodities because it has such an impact on everything that we do, from driving our cars, the diesel that we use, the plastics that are all around us. And it relates directly to the grain markets in terms of a fuel source and how it can then also impact ethanol and biofuels and soybean oil and canola oil usage in a lot of other renewables and biofuels. And we saw where oil prices reached about $120 a barrel, and then 110, and then they started drifting lower, and they had a hard time holding up above 100, then a hard time above 90, and then 80. And now just recently, as you can see there on the chart, it started to break through $70 a barrel and into the $60 level. And you know you never say never in these markets. And could oil get down to 50 or $60 again? Absolutely, right? It wasn't that long ago when you look at the chart where we were kind of hovering in a range of $50 a barrel. They collapsed during COVID in the early 2020 year, and then they made their way higher. But now we're starting to see that reverse. And nothing is going to go down or up, forever. But when one of the main commodities that impacts the pricing of a lot of other ones starts to drift lower, as we're seeing here with oil, you got to start to look at that and say, okay, we're certainly changing in these trends here. So those are some of the bigger pictures that address that inflation versus deflation scenario. And no matter what your opinion is, the markets and the pricing are showing that commodities are drifting lower under the influence here of financial gravity. And that brings to another important chart that I put together a while ago, looking at, because farming is all about it. It's a business equation like anything else, your inputs and your outputs and what's your net margin. And this was another chart that I'd put together a while ago that was very interesting and surprising as well. Well, maybe not so much surprising, but it's always good to be reminded. And what you can see here is just a comparison of a grain price index, again, the large commodities like wheat, corn, and soybeans, versus some global fertilizer prices. And the big spikes that we see there on the orange line are fertilizer prices, and they are often well correlated with the grain prices. I mean, they naturally go together in the sense that one works with the other. And we saw prices move up dramatically in 2008, and then again, of course, more recently for various reasons. But fertilizer prices have been drifting lower, as you can see clearly on the chart. And that's partially as good news because it's a major input into a farming operation, and those prices are drifting lower. But at the same time, we're also seeing those grain prices come down as well. So those are some key relationships that I know from speaking with clients is it's, and people have said to me too, they actually might have been just as profitable when canola was down at 500 and fertilizer prices were a lot lower necessarily than where fertilizer is high, and maybe higher than they were compared to where grain prices are now. And even, let's just say, use again canola at 750, 800 a ton, excellent price, but fertilizer prices are very high as well. So looking at this relationship between the two, and this is just a spread between fertilizer and grain prices, and we do have these spikes. They tend not to last long, where the price of fertilizer gains dramatically on the price of the underlying grain market. But we certainly are starting to see that move in the other direction now, and trending maybe more towards a little bit more of a normal environment. But this takes time, and it's also important too, because a lot of people may very well have bought fertilizer prices in the fall and early winter when they were a lot higher. And unless they did some forward pricing or hedged their grain, they're in a position where they may have bought their inputs at some higher prices, but now their revenues are going to be set at some lower levels at as grain pricing goes down. So this sets the stage for what do you do on the marketing side, right? That's important, is how do you try and maintain those margins between your inputs and your outputs. And This is a chart that just always reminds me that there's always a couple of sides to this equation. But fertilizer prices are certainly going down, as I'm reminded of on a regular basis when people tell me that they're just seeing prices going lower and lower. And some of that does have to do with natural gas as a major feedstock, but this also has implications for um, grain drying operation too, where that becomes a major energy source, and natural gas prices have dropped dramatically, and we saw this run up too throughout the especially in Europe, where we had some dramatic shuts down of supply that would have been coming from Russia. But now we saw these grain or these fertilizer prices drop, and natural gas prices dropping at the same time. So is it a stretch to envision that grain pricing could drop as well? No, not at all. And again, I hope I'm wrong, but we are seeing that develop. So all these commodity prices do move together. And when you throw in the fact that crude oil is coming down as well, it's pulling at a lot of these prices. And when you look at our commodities that are going to be coming out of the bins or coming off the fields, whether it's old crop or new crop, regardless, we are seeing these prices drift lower. And of course, everyone wants to see canola at 1,000, 1,100, 1,200, but it doesn't matter what we want. This is what we're seeing happening. And do prices drop back down to that $500 level again? You can never say never. I mean, we've seen crazier things happen. I mean, Bitcoin at one point in time was worth 60,000 plus US for whatever it was, some kind of digital zeros and ones in your phone, in your computer system. So all I'm saying is the market can and will do things that go beyond your wildest dreams in both directions. So we are starting to see this drift lower. It was a dramatic price rise up. And does it become a slow stair step down going forward, or do we have some kind of event? Maybe it is more drought. Maybe it is more increasing conflict in between Russia, Ukraine. What could cause those prices to go back up? We don't know, but barring any kind of major event, again, financial gravity pulls away at these prices. And everyone, it's you don't want to be chasing a market, but every time you put in some target levels and maybe they don't get filled, or you get further and further away from them, you got to start readjusting your approach and what you're going to do on the marketing side. And that's where a fairly healthy dose of objectivity comes into place, because we got to keep in mind that these prices can drift lower. And it's not just canola, and not just Canada. Here's a fascinating chart of European rapeseed futures, and it had a dramatic run up, of course, especially following the situation in the Ukraine, given how close it was. But as much as it's come down, it's basically back to the level that it was at following that dramatic price rise, and moving back up to canola again. Um, it's getting close to those levels as well, where we saw the the increase take off. And in fact, we're probably, when you look at the charts, we're starting to get well below those levels. So the impact, what was causing it to go up is no longer supporting it anymore. So it tends to drift lower. And it's not just the ones that are more impacted by Ukraine's situation, but even palm oil, Malaysian palm oil futures, and palm oil really is one of the biggest oil seed markets out there for sure. And that one too has been drifting lower. It's been holding support quite recently here, but that doesn't mean it has to hold. And you got to think too, well, what's going to cause it to go back up? We've had such a big increase prior to that markets tend to swing one way and then they swing the other. And you look at what's happening. Here's just another chart of Chinese rapeseed oil futures. And there was a lot of talk recently, I think it was sort of November, December, where there were some fairly dramatic purchases by China of our canola, and a lot of talk about how they were big buyers in the market. Well, that was true. When you look at what the price of their domestic rapeseed oil was doing, it doesn't sort of corroborate that extreme demand that you'd think would come through, because their prices were drifting lower here and have dropped through some major support. And it wasn't too long ago, a couple of years back, where the prices were half of what they had reached even just a few months ago. So we know these prices can have big swings both ways.
Oh, sorry. I didn't
Yeah.
want, can I jump in there real quick?
Absolutely.
The business eye here is spotting some trends. And I know we'll probably chat about this a little bit more as we wrap up, but I'm sitting here going, okay, you're clearly outlining some trends that kind of match from commodity to commodity.
Right.
And this might make sense to leave after touch here. We can do a combination of both, but I'm sure myself and a lot of farmers are going, okay, how do we proactively get on top of this?
Right. And everyone is different, everyone's approach is different, but I think what is the common across this whole thread here is that prices are drifting lower. You're absolutely right, Tracy. And you can't, everyone can have an opinion, but the price trends are certainly showing it drifting lower. And it doesn't mean it can have some rebounds and move back up. Absolutely. And those would really be one opportunities to perhaps protect a little bit more grain that from, certainly old crop, but definitely on the new crop side as well. And it depends on how much people have priced. Like if they're sitting, then they've already got maybe a quarter or a third of new crop priced, and they're sitting now at a level where they're not too comfortable pricing a lot more, which makes sense because you don't want to take on too much delivery risk. That's where options really come into place, and futures too, because it allows you to protect these prices without having to commit your grain at the same time. So there is a way to very proactively capture these prices, but also not paint yourself into a corner as it relates to the delivery side of it in the fall, because who knows what kind of yields we're going to see. So far, we've got decent moisture coverage in a lot of areas. Some are certainly dry, but regardless, you never want to price too much. So that's where being on top of on the marketing side of it comes into play, either with some just some physical sales to bump up your percentage sold, but really options fill in an extremely important hole right here by giving you just more flexibility in your marketing.
Okay, thank you. Sorry, I had to jump in there. I'm like, okay, I'm sensing a trend, and I know we're all thinking of it.
Yeah,
we're watching, we're going, okay, wait a minute, how do we prevent this, right?
and that you're absolutely right, Tracy. And that's where these kinds of conversations come up on a regular basis, where people have felt maybe they haven't priced as much as they should. Maybe they're hoping some of their targets get hit and they're not, or that prices have a rebound. And that's all fine and good, but you don't want to put too many eggs in one basket, so to speak. And again, that's where options really let you do, kind of have your cake and eat it too, to some extent, because you can have that ability to set a wide range of prices. And if they go down, great, you're protected. But at the same time, if they move higher, you haven't locked in and committed, to a price, and also to a certain amount of production. So all these grain prices certainly are moving together, and they are drifting downwards. And as we go forward, the same story repeats itself. With wheat futures, they broke through a fairly important support level just recently here, and adding to some sales, depending on how much you've done, adding to some option hedges is going to let you have maybe a little sleep better at night type of thing, because you may have locked in some of of course, some people have said, no, I didn't really lock in much of my fertilizer prices in the fall, which is a good thing because now they're lower. But sometimes luck goes for you, sometimes it goes against you. But when the trends are fairly pronounced, you don't want to leave too much to the market. And same story here. This is just a chart of European milling wheat futures, and once again, fairly dramatic move up, of course, because of Russia-Ukraine situation, but drifting lower and lower as well. And Corn, and as we'll see on the next slide, soybeans have held up a little bit better than some of the other markets. Perhaps that's because of what's happening in Argentina. Um, Various factors are in play there, but what it does do is it does show we're at some important support level, and this is just new crop corn futures. And yeah, we're at an important support level here. And what does that mean? Well, it means that it still gives you some pretty good opportunities, even at this level here, to capture some of these prices, and whether it's adding a little bit to some new crop sales, or of course looking at option strategies. And because corn and soybeans are such liquid markets, you can really do a lot with them, as well with the canola and wheat too, but certainly with corn and soybeans, to really put in a very wide range of beneficial prices that if they go down, you're going to be happy you did so. But even if they go up, where you're going to be able to capture a fair bit of upside on these price moves. And here's soybeans as well, new crop soybeans. Chart has been quite well supported. It's holding up, but again, it doesn't take much for soybeans to have a move either way. But I think certainly we always got to keep in mind that the risk is always to the downside, as I'm told, many times throughout the day. Is yeah, of course I want more upside, but I'm much more concerned about the downside if it materializes. So depends on where you are. In southern Manitoba, certainly there's a lot of crops from corn, wheat, soybeans, canola that give you a lot of hedging alternatives compared to maybe Alberta way, or in the west where you might have a lot more lentils, peas, durum, which you can't hedge as well. There's no futures and options for them. But maybe that means you just become a little bit more proactive with your wheat and your canola and even barley. It's not a stretch to use corn and maybe wheat futures as a bit of a cross hedge for your barley as a feed component. And if nothing else, it can act as just a general hedge on all of your revenues, because if they all tend to move up and down together. Certainly some markets can have some pockets where either lentils or peas or durum or canola or wheat have a big move one way versus the other, but by and large they've all gone up together over the past couple of years, and now they're kind of starting to move down together. So there are ways to fine tune that marketing and not be so beholden to what the market's been doing. And then also looking at some of the financial markets as well. I mean, this is no surprise. Interest rates have gone up dramatically. And this is just a picture of sort of 6-month Government of Canada Treasury bill interest rates. And yeah, they moved up from essentially zero to about 4.5%. And, I don't have to tell people what that means on the financing side. A lot of people did start to, extend their loans, renegotiate, or when terms came up, or switch variable rate into fixed rate a couple of years ago, throughout 2020 and 2021, which was great. And then we saw the rates going higher. A little bit more difficult now to do anything about it, but there are actually ways that you can hedge interest rates with futures as well. So there are tools that if you're still concerned about rates going higher, that you can do so. But this also comes back to the question you asked earlier, Tracy, about inflation versus deflation. And will central banks continue to raise rates? Sure, they might continue to do that. But, if they've gone from essentially, 0 to 4.5%, could they go up another 4.5% and get up to the 9% level? I doubt it, but hey, never say never. But I think we're starting to see some of those inflation factors switch over a little bit more to the disinflation side. So interest rates have moved up, but it hasn't had much of an impact on land prices. When you see a lot of reports that have been done lately over the past 6 months to a year, land prices across Canada have still moved up anywhere from 6, 7, 8, 9, 10, 11, 12, 13%. So given that's such a major investment that farmers make, up till now it hasn't had an impact. Does it start to slow that down? Perhaps, but maybe it's grain pricing going lower that could have a bigger impact on how aggressively people might bid for land going forward necessarily than interest rates. because that'll determine your profitability on the land. So interest rates have moved up. Doesn't mean the rate rising cycle is over, but it certainly has come a long way. And throughout that whole time frame, the Canadian dollar has more or less weakened. When a couple of years ago it was sitting at almost 83, 84 cents to the US, and now we're right back down to the low end of the range, sort of 72, 73 cents. And does it get to 70 cents? Certainly it can. We've seen that in the last 7-8 years here, where the currency can get to 70 cents or lower. And that helps with your basis levels, that helps with your bids, because let's face it, everything that we grow and sell gets priced in US dollars. So for now, that's a supporting factor, and for the time being looks to continue to be the case. But doesn't mean certain that it's going to be that way forever. So it's good to keep an eye on that. And I think the most important picture to kind of keep in your mind, if people can come away from this episode with nothing else but keeping this picture in mind, I think is important, because again, we've seen this type of move, over a dozen times in the last 50 years. And most of the time we see it drift back down to where it started. So those are the patterns, those are the trends that we're seeing. And I really do believe that the marketing has to adjust accordingly to capture this new environment that we're in, and unfortunately we might continue to be in.
Fantastic. This was an amazing long-term big picture outlook. Thank you, David.
Thank you. You're welcome. I think pictures are worth 1,000 words, and yes. It's the nice thing about charts and prices like this is everyone can have an opinion, but the price is the price is the price, and whether it's going up or down is not necessarily subject to opinions. It's more so that's just what the prices are doing, and you got to be proactive in that situation and also react accordingly. So it's good to look at pictures. I'm always a fan of that.
I was going to say, call me a visual person, which I know I am, but this seeing it and the trends, seeing it visually versus being told this audio, so much better. Okay, well, you went through all the different commodities, all the different things that play for grain marketing as we are standing right now. And I know you touched on this throughout the presentation a little bit here and there, so I don't want to be too repetitive, but I'm going to ask you a few things and really get you to give some final words of wisdom. So why don't you wrap it up talking about, okay, based on what we just seen here, how the markets are trending, how does this relate to marketing? What can farmers do about it? And then after that, let's chat about how you can really help them. And I know you touched a little bit here and there, but let's tie it all together.
Right. Well, I think the biggest factor is that you have to take a good look at just where you're at in terms of your marketing, especially for new crop. Old crop, most people I talk to, and they've already got 80%, 75, 90% priced, whatever it might be. New crop is always a little more challenging too, because you don't want to be pricing too much of what you don't have yet, and that is always the issue, because sometimes the best time to price your grain is also the worst time from a production risk point of view. So I just see it over and over again. Having more tools in your toolbox is important, and getting comfortable and confident in options and how they work is really key, because it lets you be a little bit more flexible and comfortable in an environment like this, when you can put in place some price protection, some price insurance. So that to me is always a key. That's where my area of focus is, and it complements what you're doing on the cash side. If someone's already got a decent amount of new crop sold, quarter, third, maybe half, depending on what it is, options can come in and help you get to that next level. If you want to get to 50%, or maybe you want to get up to 2/3, they allow you to do that without taking the same kind of production risk or just locking in, because it is possible we get a little bit spike back higher and prices go up. You can't rule that out either. But if we do get that, that should be viewed as an opportunity to maybe add to some more sales, to use options to capture those prices. And that's, it's getting comfortable with them too. And because for a lot of people it is a new tool, it is something different. But I tell you, once people get comfortable with it and use it, then they just see the value of it immediately in their marketing operations. So and that's what I help people with. It's not just the actual execution and monitoring and structuring these hedging strategies. A lot of it is that component of getting comfortable with it, learning about it, getting confident in using this in your operation.
Excellent. That was my next question. Whether you are a newbie and know next to nothing about all the tools you just mentioned, or whether somebody has a good level of knowledge and confidence, you work with all farmers, right? Different ages, stages, sizes, not of the person, of the crops.
Yeah, absolutely. Absolutely. And it really is. And I mean, I've been doing this for, I don't know, 25 years now, and every day is different, right? That's one thing that you're guaranteed on, is that every day, every week, every month is going to be different. And sometimes one strategy fits very well in one environment, and then conditions change and you have to adjust your strategy too. So, it's, whether you're very green to this or you've been doing it for years, you can always learn something new, and you can always find ways, and perhaps a better way to do to do your marketing, because as markets change, these strategies can change as well. And markets are always going to change, so you kind of have to be able to move along with them.
Yes. Okay, perfect. So if there is a farmer in the audience that is wanting to know more, wanting to learn more, wanting to work with you, how can
Right.
they connect with you?
Well, the best way is really, reach out to me. I'm happy to speak with people, assess the situation, and see what I can do for them. And everyone is different, whether it's crop size or farm size or different types of commodities. And you might be sitting there thinking, well, all I grow is lentils and peas and durum and canola, and you can't really do much with most of those crops. And while that may be true, there's always other sides of it where maybe that means you ought to be even more proactive with your canola, where you can do something because you don't have the same flexibility on the other crops. Or it could be a matter of looking at the Canadian dollar, or hedging some of your fuel costs. So there's a lot of moving parts to any farming operation, and I think just the first step is happy to talk to someone. They want to reach out and see if this might be able to work with them. Then that's the first step. So anyone in the audience, don't hesitate. I'm happy to answer questions and help out that way.
Perfect. Again, David, this presentation has been fantastic. Thank you for sharing your time and wisdom with myself and our audience.
Well, thank you very much for having me on the show, and let's see how the rest of these pictures develop over the course of the new crop marketing year.
Yeah, it's always interesting. We talk at this point and at this point. So what are we going to be talking about next time? That's always the fun thing to guess. Let's hope it's good.
Yeah.
Well, David, again, thank you. And you in the audience, thank you so much for joining us. If you enjoyed this episode as much as I did, like it, share it, and get it out there so other farmers can hear the message that David just shared. Thank you, guys. See you next week.